evening. Welcome to the workshop session of the Mayor and City Council of the City of College Park. I'm Mayor Bianca Motley Broom. It is 6:01 p.m. We have a full quorum present with council members McKenzie, Karn, Arnold, and Gay, so I will call the meeting to order at this time.
The first item on the agenda is presentation of the annual comprehensive financial report for fiscal year ending June 30th, 2023 by external auditors Mauldin and Jenkins, LLC.
Good evening, Mr. Moses. How are you?
Pretty good. Good evening to everyone, and thanks for having me here today to present the audit results for the City of College Park. Fiscal year June 30, 2023. Hopefully you had a chance to kind of glance over the annual comprehensive financial report. I know it's a big document, but we'll talk about some of the highlights. Can you hear me okay?
I think Mr. Curry is signaling to me that you need to get a little bit closer. No, not the yellow one.
Sorry. Can you hear me okay now?
Yes, we're
All
good.
right.
Thank you.
Okay. So again, the ACFR, then the single audit report on your federal award programs is a separate document, the thin binder here. And then as far as what I'm going to present today is going to be from the auditors' discussion and analysis, which should be pulling up shortly.
It's coming.
It's coming, okay.
Yeah.
Do y'all have it in front of you, hard copies?
Yes, it was in their package.
All right. So let's go to the next slide. Next one. All right, so just a quick update about Mauldin and Jenkins. Again, we've been around for over 100 years. We actually audit over 700 governments in the Southeast. Smallest city government we audit is City of Ball Ground, and the largest one is the City of Atlanta. Of our 700 plus clients that we serve in the Southeast, 150 of them received the GFOA Award in Excellence in Financial Reporting, including the City of College Park, who has received that award on numerous occasions. We actually have 14 offices in 6 states. Our latest office is in Raleigh, North Carolina. And one thing I wanted to point out here, that one of our former partners at Mauldin and Jenkins, who's Joe Black, who used to do the quality assurance review for the City of College Park. I always used to have him to do that. He was one of our most technical partners. He's currently the chairperson of the Governmental Accounting Standards Board. He's serving as the chair, going into his 4th year, I believe, of his 7-year term. And Joe Black, again, GASB is the board that sets the accounting standards for federal, state, and local governments to follow. And so someone from Mauldin Jenkins, who used to be a partner at, here, also the partner that kind of did the technical review for College Park while he was here as well, sits on that board. So I just wanted to point that out. Next slide. As far as the engagement leaders, I was the partner responsible for the overall audit of the City of College Park with over 25 years of experience. Correction here, I did have a different partner to do the quality assurance review, Trey Scott, out of our Savannah office. He's the partner in charge of that office with 18 years of experience. First time being involved with this engagement, so he did the quality control review. Also, Mallory was the manager. She served on the engagement for a few years. I had a different senior to work on this audit for the first time. He's actually a remote senior, Kevin Green, out of our Texas office. And then we had other staff, some returning, some new on the audit engagement. Down below, just some other industries that we serve and other services that we provide other than your traditional accounting and tax services. Next slide. As far as the financial statements, they are the responsibility of management. Our responsibility is to give an opinion that the financial statements are materially correct. We've issued an unmodified opinion on the basic financial statements, which includes your blended component unit, the College Park Business and Industrial Development Authority, or the Redevelopment Authority. Also, within your financial statements, presented as a discretely presented component unit, is the Destination Marketing Organization, Inc. Those financial statements were audited by other auditors, and we relied on their report. Next slide. As far as the report, in accordance with government auditing standards, or the Yellow Book report, we had no material weaknesses, significant deficiencies on the financial statements, nor did we have any compliance findings as well. So kudos and hats off to management staff and others for working very hard. You have a finance director who, had prior experience, serving as a finance director in Florida, and she's done a great job here at College Park, making sure that the audit is being done, or the information provided for the audit is being accurate and timely provided, so that we can issue a timely audit. Also, you have a accounting manager. When we first started doing the Cobb County's audit, she was there working for the Cobb County and was responsible for drafting the financial statements, and that CFO would have her to update those financial statements monthly. That's very difficult to do. And so again, she's here, been working with the city for the last several years as well, amongst others too. So again, they do a good job of getting ready for the audit, and pretty much a very clean audit. Also below is the report in accordance with the uniform guidance. As it relates to the single audit, any governments that receive or spend $750,000 of federal awards is required to have a single audit. And so you have to go through and pick which programs are required to have that single audit done. The city received and expended $11.3 million of federal awards as of June 30, 2023. Okay. There was 2 programs that we had to audit. Those programs covered $10.3 million, or 91% of the total expenditures. And that was your coronavirus state and local fiscal recovery funds, as well as the highway planning and construction program as well. So clean opinions on those 2 programs as it relates to the compliance requirements, as well as the internal controls pertaining to those 2 programs. Next slide. Main thing here I want to point out is, as it relates to accounting policies, and the correction here is GASB 96 that was implemented this year, dealing with subscription-based IT arrangements. And so that standard is very similar to GASB 87, dealing with leases, which was implemented in fiscal year 2022. And so again, it goes into to recognize that governments should be recording the SBITA assets and liabilities on the books. Like if you have a cloud-based system, that would be considered a SBITA. And so management went through all of their SBITA type arrangements and determined that there were no material arrangements that should be recorded in its financial statements. But that's something that has to be evaluated each year as you move forward. Next slide. As far as our relationship with management, we receive full cooperation from management staff and others. There were no disagreements with management on accounting issues or financial reporting matters. As far as audit adjustments, we did have some audit adjustments. Those audit adjustments are within the back of this document. There were no past audit adjustments, meaning that anything that came to our attention, we made sure that those entries were reflected in the city's financial statements, as well as in the city's general ledger. Next page. As far as our independence, we are independent of the city and its financial reporting process in accordance with ACFR professional standards. There were no fees paid to Mauldin and Jenkins for any type of management advisory services that would have impacted our independence as your external auditor. All right, the next slide kind of goes over some financial trends. And so I know we have 2 new council members, and I'll just kind of want to point out some sections of the actual financial statements that you can go to. I know it's a 121-page document, unless you just want to read it at night before going to bed. But just want to kind of point out some sections that you can look at to get a high-level review of certain things. The first one is the management discussion and analysis. That's on page 5 and ends at page 16 of the ACFR, and that's prepared by management. Okay, and so you can look at how the city performed in the current year compared to the prior year, and explains why certain balances increases, or revenues or expenses increased in the current year or decreased in the current year compared to the prior year. So that's a good place to start there. Also, I would recommend looking at your cash flow statements for your proprietary funds. That starts on page 29 and ends on page 30. And so you can see how the city's proprietary funds, like your electric fund, water and sewer, and so on, how they have performed. Are those funds self-sufficient? Are they able to cover their operating costs, or, you know, you have other funds subsidizing some of those deficiencies through transfers in and things of that nature. Also, I would recommend looking at your long-term debt schedule, footnote schedule on page 52 through 62, as well, and that's your external financing, and then also your internal financing, your inter-fund balances and advances from other funds, which is on page 72 and ends on 73. And then the last section I would say to look at is the statistical section, also prepared by city management. And again, some of the information within that section covers financial trends, revenue capacity, debt capacity, demographic and economic information, as well as operating information on a 10-year period. And so those are good sections to kind of look at. All right, so as far as this chart here, this is looking at your electric fund and your other proprietary funds, pretty much total revenues over the last 10 years. And so you can see that the electric fund continues to do well, $42.1 million in 2022 to $45.5 million in 2023, while your other proprietary funds went from $33 million in 2022 to $43.9 million in 2023. And the main reason for the increase in your total revenues for your other proprietary funds pertains to the water and sewer fund receiving, for the first time in 2023, the municipal option sales tax revenues of about $7 million. And so that was a one-time, well, it started in fiscal year 2023, and so that's the reason why your other proprietary funds revenues increase significantly over the prior year. All right, next page. All right, this is looking at your change in net position or change in equity over the last 10 years for the electric fund again and your other proprietary funds. Your electric fund net position increased from 3.3 million to about 4.2 million in the current year, while your other proprietary funds had a decrease in net position of $210,000 in 2022, and then increased to $6.5 million in 2023. And again, the main reason for that was the most revenue that was received in the water and sewer fund of about $7 million. One thing else I want to point out here within your other proprietary funds is BIDA. You know, BIDA has a deficit net position of $4.6 million. It has external financing revenue bonds of about $72 million, and it has internal financing between advances from other funds of about $9.7 million. And the majority of that is owed to $3.7 million to GICC Arena Fund, $2.2 million to the Water and Sewer Fund, and $3.5 million to the Electric Fund, and about $250,000 to the General Fund. Now again, these advances, again, back in, I believe, 2014, the council passed a resolution as far as a repayment plan on how these advances are going to be repaid. So just like external receivables, you want to look at, does the fund has the ability and intent to repay those external receivables? I'm sorry. Are those receivables collectible when you're looking at utility receivables and things of that nature, okay? Just so you have to do the same thing with these inter-fund balances. You can't just carry a large balance and the fund doesn't have the ability to repay it. So at that time, we got with management got with the council, and they approved that BIDA would be able to pay these advances back through the proceeds from the sale of capital assets or the undeveloped land. And so that's been the plan, and again, it has come down. It was much higher than $9.7 million. So I just wanted to say that, so if BIDA sells land, you know, those proceeds are supposed to be used to repay these advances. If you all agree, hey, they don't need to do that, then you have to write off that advance as a transfer out up to the amount of proceeds that was received from the sale of land. So I just wanted to point that out and make sure everyone is aware of that. Next slide is looking at your electric and water and sewer fund bad debt reserves over the last 10 years. And still seeing an upward trend in your bad debt service, bad debt reserves. Electric fund went from 8.8 million to 9.4 million in 2023, while your water and sewer funds went from 1.6 million to 1.7 million dollars. It's my understanding that the city still utilizes a third party to try to collect on the bad debt reserves of those delinquent accounts. You know, something that the city may need to start doing, if you haven't already started doing, is looking to cut off, you know, services if someone's account goes delinquent for a certain number of months until they're able to repay. Next slide is looking at your fund balance over the last 10 years for your general fund, which is the city's main operating fund, and then your other governmental funds, special revenue funds, capital project funds, things of that nature. And so your fund balance for your general fund increased from $23.6 million in 2022 to about $32.2 million in 2023, while your other governmental funds went down from $28.2 million to $26.1 million. One thing that I'll say is that your fund balance could decrease in future years. As you all know, the city did do a refunding a few years back coming out of the pandemic to defer principal payments on its revenue bonds. And so again, that started in fiscal year 2021, and it will end at the end of this fiscal year that you're in. And so your first principal debt service payment will start in September. And so the general fund may need to start transferring money to those funds to cover some of those debt service payments. Next slide. All right, this slide is looking at fund balance as a percentage of total expenditures. So this is a liquidity type of ratio that you can look at. Most June 30 governments, the rule of thumb is to have anywhere from 2 to 3 months reserve, or anywhere from 16 to 25%. If you're in that range, then you don't have to rely on the tax anticipation note subsequent to year end to get you through those months until your property tax revenues come in. You all have a very strong fund balance. Again, this is a snapshot in time. Doesn't mean that you're at this level throughout the year, but at June 30, 2023, your general fund balance as a percentage of total expenditures went from 80% to 93%. That's an 11-month reserve. Now, if you look at all of your governmental funds, that percentage went from 281% in 2022 down to about 98% in 2023. And so the reason for that huge decrease when you're looking at all of your governmental funds is due to you all issuing a T-SPLOS bond in 2022 of about $10.9 million. And so that increased your fund balance that year. And then you also had less expenditures in the T-SPLOS fund in 2022, which was about $2.5 million compared to about $10.6 million in 2023. And so that's why that percentage for all of your governmental funds dropped down to 98%. But again, very, very strong fund balance at year end when you're comparing, again, fund balance as a percentage of total expenditures. Another way of looking at liquidity for your fund balance for your general fund, and a lot of times people mistake fund balance for cash. A lot of times that's not the case. But looking at your fund balance compared to cash equivalents is very liquid. You had cash at year end at $26 million in your general fund. You had total fund balance of $32 million. Unassigned fund balance was about $24.9 million. So looking at cash to total fund balance, that liquidity rate is 123%. Comparing unassigned fund balance, that liquidity rate is 96%. So again, those are two different liquid ratios to kind of look at for the city of College Park for your general fund, and again, both are pretty strong. Next slide. This is the last slide for financial trends. This is looking at your multi-purpose gateway GICC Arena Fund. Losses before transfers compared to transfers in from other funds. Of course, this fund has been around for 5 years now. And again, you can see how at the bottom here, your losses each year over the last 5 years. You had a loss of about $3.5 million in 22, and then it went down, an increase loss of 4.5 million in 2023, while your transfers in about 4.1 million in 2022 compared to $4.4 million in 2023. Like I alluded to earlier, you'll see more transfers coming in to this fund to meet debt service payments when you start. You've been making interest payments, but you're going to pick up making those principal payments in September. But overall, again, your financial condition looks pretty good, which leads us into this next management point here that, again, you still have to look at not only your external financing arrangements, but also your internal finance arrangements as well. And so this is something that we always kind of repeat here, that, looking at your proprietary activities, for instance, for your convention center fund, you got $34 million of outside financing, about 3.1 million of internal financing between advances from other funds and due to other funds. You got annual principal and interest payments that are being made out. But one thing to note is that as planned, you do have transfers coming out of your general fund and your hotel motel tax fund. And so that's always planned each year. And so it's able to cover some of those deficits. And so for fiscal year 2023, the convention center still reported net loss from operations of about $4.4 million. But again, it still has positive net position or equity at the end of the year. But again, those transfers from the general fund and the hotel motel tax fund are planned and consistent each year for the most part. Next slide. Like I mentioned earlier about VITA, again, outside debt of 71 million, internal finances of 9.7 million, continues to have a deficit fund balance. Again, proceeds from the sale of land should be used to repay those advances. And then the GICC Arena Fund has $30.4 million of outside financing. And again, about $2.9 million of annual debt service payments that are required in subsequent fiscal years through fiscal year 2036. And it had a net loss of 4.5 million, transfers in of about $4.4 million. And so it did have a positive increase in fund or net position of $100,000 due to those transfers in. And so we just say that, to continue looking at, monitoring these activities, not just at year end, but on a monthly basis, just to make sure that you all are able to cover those shortfalls in operating revenues compared to operating expenses, and then with the transfers coming into those funds to subsidize some of those deficiencies. Next slide. Customer deposits, again, this is something that we recommend that, dealing with customer deposits, you should have a separate bank account set up for those customer deposits. Make sure that you're doing reconciliation between the customer deposit liability with the cash that's in a separate bank account. Shouldn't be commingled with other operating cash, and something that we continue to recommend. And then the last management point here deals with operational assessments. Sometimes people get confused with what a financial audit entails versus having an operational audit or performance audit done. As far as a financial audit, our responsibility as external auditors is to give an opinion that the financial statements are materially correct and free from errors and misstatements. We're not required to give a report on internal controls. Auditors are required to gain an understanding of controls in place, right? But that's through walkthroughs, interviews, things of that nature, but we're not doing detailed testing of internal controls unless it's related to the single audit for federal award programs. So that's different from an operational assessment where you come in and you look at the internal controls and seeing if they're operating effectively. You're looking at your policies and procedures, you look at where you are currently, where you need to be based on best practices and things of that nature. And so you do a gap analysis, make recommendations, and how the entity can implement those recommendations. And so that's something I do recommend the city consider, considering that you have new leadership, new council members, a lot of turnover as it relates to the city manager position and things of that nature, and some department heads. This will be a great opportunity for you to come in have this operational assessment done, and then kind of go from there. And so we've had other clients to do this. Gwinnett County did a county-wide operational assessment. The City of Forest Park did a city-wide operational assessment. And so that went over very well with the governing body members as well as the management staff and others. Now, one thing I will commend the city, another thing I will commend the City of College Park on, is something that I don't recall, and I haven't done a survey of all of our clients, but I was very impressed to hear that you all have a cybersecurity officer. I don't recall any of our clients having that. So that is pretty huge, and considering, you hear, what's happening in the news with these cyber attacks. I mean, they can really put you in a bad place with these ransoms and, putting your information out there in the dark web. So again, kudos for you all approving for the city to have a cybersecurity officer, and that's very important. So I wish other governments would consider having that, because that is very important to protect and safeguard the city's assets. So that's huge. So again, kudos for that. All right, almost done. Next slide. All right, so 2 new GASB standards, and I don't know if I can give Joe Black credit for this. Normally they're very busy in implementing a lot of standards. It kind of chill a little bit of late. But these 2 standards here, dealing with accounting changes and error corrections relating to GASB Statement 100, that's applicable in the current year that you're in. It really kind of clarifies and provides a little bit more detail to whenever you have a restatement or correction of the prior year balances. You got to provide a little bit more information in the footnotes. And then also if you have a change in major funds or non-major funds from one year to the next year, normally we don't have to disclose anything about that. But now you're going to have to reconcile how do your non-major funds from prior year change this year, if there's a change. So that has to be reconciled in the footnotes. And so that's going to be kind of fun to deal with. And then the last standard here deals with GASB Statement 101, dealing with compensated absences, your accrued vacation and sick leave. And so a lot of governments as well as auditors are very happy about this standard, because normally in your footnote disclosure for long-term debt, you have to show additions and deletions for compensated absences. And sometimes that's hard for clients to figure out, okay, what was the additions, what were the deletions? If you know 3 out of the 4 items, beginning, additions, deletions, and ending, you can back into that last item. So now they say just show the net change. So if you know your ending, if it increased in the current year, you show that net change as an addition. So that's pretty cool. We like that. Next slide, just GASB continues to kind of look at different things. They have these projects that's underway, and a lot of times before they make a standard, they want to get information and feedback from the local the governments as well as the auditors, and so that allows us to provide feedback on the pros and cons to some of these projects that they're coming out with before they make it a standard. Next slide. We continue to offer free continuing education classes for our clients. Again, this is free of charge. You can earn up to 28 hours of CPE credit. The city's staff have attended those courses in the past, and I believe one of your council members in the past was one of our first governing body members to attend one of those classes. And so it's open to you all as well. And you can see the various topics that we offer. During the pandemic, with the influx of federal grants coming in and the complexity surrounding those grants, we had probably additional 10 classes for our clients just to keep them abreast on how to report certain things, how to account for certain things, making sure they know what the allowable expenditures were to kind of keep them, abreast of those things so that they wouldn't get in trouble. And then we also on the next page offer newsletters. We provide governmental newsletters to our clients as well. So we get wind of something that we think our clients need to be made aware of it, we'll go ahead and send that out to you as a newsletter blast. And so if you want to be included on that invite list, let me know and we'll get you added. But that concludes my presentation. Again, always a pleasure and honor to provide services to the City of College Park. And at this time, I will address any questions that you may have.
Thank you, Mr. Moses. We'll start with Councilmember McKenzie.
Hi, how are you doing today?
Pretty good, and you?
Okay, I don't have a question, but I definitely want to be on that invite list.
Okay,
Okay.
gotcha, added.
Councilmember Carn?
All right, how you doing?
I'm pretty good, sir.
Got a few things.
Okay.
One of the things that I'm seeing kind of lately, the financed purchases for the borrowings, the vehicles and equipment, it kind of seems like a new trend. I mean, before when I served, we weren't doing too much of any of that. Are you seeing a lot of that with some of the other cities or counties?
Yes.
And why all of a sudden is that starting to get popular?
Gotcha. So, under the previous standard, they were referred to as capital leases. So, a lot of times, city governments, of course, will lease out the police vehicles. And so, we see that a lot. And so, with the new standard, GASB 88 a few years back, you can no longer call those leases capital leases. And so, we call them finance purchases and things of that nature. So that's where you're seeing that finance purchase. But again, this is normal, what we see amongst a lot of city and county governments, that they're leasing out a lot of their vehicles or other, public works vehicles and things of that nature. So this is not unusual. Sometimes you get a better deal with those type of arrangements.
Well, and in the past, I mean, we've leased and we've bought cash as well. I mean, we've bought straight out, but a lot of times, every time staff wants to do something, they say, well, this is the better way to go if we're leasing it. Then if they want to buy something, well, this is the better way to go with that. And you always say to yourself, well, I guess it's different types of financial vehicles that you're looking at for different things here. The couple of things I saw on a couple of these pages I just wanted to ask you about. The arena, that's one I think we definitely need to work on. I was looking at this on page 16, and that middle paragraph at the bottom, without major future operating revenues, the arena fund will have to, rely on internal financing and transfers. I worry about the arena. It's still kind of new. Mercedes has always said, we still don't know exactly what that arena is actually capable of in terms of going to its full potential. And I want us to keep that in mind. We've got the basketball contracts now. Whether or not they're there in the future, we'll see how that goes. But I want us to keep in mind, City Manager, that's a multi-purpose arena. And it was designed as a multi-purpose arena. And sometimes we can get, tunnel visioned into the things that we know in the bread and butter. But I want us to always start looking at some new things that we can bring to that arena in hopes of bringing new revenues. The operational assessment thing, page 17, citywide operational performance. In December, we were talking about that. City Manager, I don't know if you're familiar with some of these kind of organizations. The one I'm familiar with, Corn Ferry, are you familiar with them? They do organizational restructuring for businesses and entities of government, Deloitte, McKinsey. So I think bringing in one of those outfits to do a fully realistic assessment of citywide operations, performance, staffing, I think we should be operating a whole lot leaner. I think there's a lot of overspend in some areas, but getting a professional outfit to come and really look at all of our departments and see what's going on and what we're getting dollar for dollar is going to be really important as we have a new 50% new government here. So I always try to keep my own things, and I worry. I mean, we do better than some cities, but I'm always kind of running scared here. And last thing I say, I guess Althea, I guess part of this is you, but we usually lowball our anticipated income and tax revenues, and I believe that, being conservative is always pretty smart. I guess the question is, how much we lowball, should we lowball? Is there such thing as over under anticipating revenues? I mean, is that ever a bad situation, or do you just measure it and keep in that extra gravy that comes in? It's always looks like a great windfall, but are we, is that anywhere out of order? Are we in the margins or in the median, or where we're supposed to be in terms of conservatively underestimating the revenues? And I guess Althea, I know she knows about it, but I don't know if you look at that with your analysis.
One of the things I look at is, and she can come in and chime in as well, is I look at if you're comparing your budget to actual, throughout the months, and you see, okay, we didn't anticipate this additional revenue, we didn't anticipate these expenditures, and then amending those timely, I think that is key. Some governments do no amendments until, during the audit starts. When the audit starts, and then we have these adjustments for accrued payroll, or I'm sorry, for accounts payable, you have additional expenditures, and then once all the adjustments are done, then they take that to the governing body to amend. And so you look at their budget to actual, budget equals actual.
And it's a big difference.
Now, to me, those amendments are not timely, but, the state statute doesn't say anything about timely amendments. And so we just, we make management points about, hey, you need to do amendments more timely. I think you all do amendments, throughout the year. And so I say to that, if you're conservative, you kind of lowball it initially, but then if something comes in that you were not anticipating, as long as management is coming to you and saying, hey, we have this amendment, we have additional revenues, or we have additional expenditures, we may need to cut back in certain areas and things of that nature. So if they're making timely amendments to you all to approve, I think that's key.
Well, I guess the question, what is timely? Should it be quarterly? What are we doing after you? I guess, how often do we bring those unanticipated revenues in when we know what we got?
Normally, I'm more comfortable at 6 months, primarily because the timing of when we receive those large tax payments. Right now, our last tax due date was about, I think, January 26th, Philip? Like January 26th. So we receive those numbers, and what Philip does is basically provide me with a percentage of collections based on what was billed. So for me, it's more so when those taxes actually come in, and they normally don't hit until December 31st or January 31st.
Well, the property taxes, I would imagine, those are the pretty stable ones that you can predict probably with the most accuracy. The ones I talk about, like we've got surpluses in now, the hotel motel, the mixed drink tax, the ad valorem, the rent-a-car and stuff like that. Those are the ones that aren't those a little.
And even with hotel motel, I know exactly that we're supposed to receive $3.2 million, but normally we have an overage, and that I don't receive that till like December, early January. Those two, it's pretty much the timing. Those don't come in until after the 6-month mark of the fiscal year. So normally for me, March 30th, March 31st would be the date that I would bring any amendments. I have one now because basically what I'm seeing, the trend, and sometimes I base it on what I received the previous year. So, and even with the business tax licenses, those basically don't come until March, April. So I am normally looking at how we ended in 2023 and taking that estimate and increasing it based on that.
Okay, all right. Well, the rest of my stuff I have for the financial thing, but we're not doing that today. So, we definitely appreciate it.
Let me just say that with the financial statement that Ed will present, I'll bring back those more up-to-date numbers, show you where you are come March 31st and where we anticipate that will be June 30th. Okay. So those numbers will be updated.
All right. And City Manager, you said we are putting this out for bid, this to take a look at. All right. Okay. All right. Thanks a lot.
Councilmember Arnold.
Councilman Carn asked the question or made a statement, and you responded to it. Thank you. Oh, but I do want to be added to the email list.
Okay.
Thank you.
Councilmember Gay.
Hey, Mr. Moses, I just had a couple quick questions.
Okay.
With the BIDA, did you say that you're having finance write off the debt? And if so, approximately how much debt? And how much does BIDA owe the city?
Gotcha. All right, so currently, as of June 30, 2023, BIDA owes the various funds of the City of College Park about $9.7 million. And so my point about, again, you all, back in 2014, approved a repayment plan. And for those advances to be repaid by BIDA to the City of College Park through proceeds from the sale of land, undeveloped land. And so my comment was, if, let's say, for instance, in June 30, 2024, BIDA sells $8 million of land. But instead of repaying the city, it goes out and buys some more land. Then at that point, the city needs to write either, again, I would say write off the $8 million if the city is not receiving those proceeds to repay that, for the BIDA repaying those advances. Because at that time, again, BIDA still would have a deficit for the most part in its net position, and no longer is the intent there to repay the city. And so we can't, the auditors coming in and looking at these advances and seeing if it's collectible, is no longer collectible because they sold the land and didn't use the proceeds to repay the city.
So we are writing that debt off?
No. When the BIDA does sell land, those proceeds go to repay those advances.
Okay. And my second question is, did I hear right or read right that the the GICC lost $4 million in 2023, or was that slide went so fast?
It was, I think that is correct.
4 million?
So it had a loss before transfers of 4.5 million.
And is that in 2023?
That's in 2023. And you had transfers in of 4.4 million.
And that doesn't include losses from the arena. The arena has its own fund.
That's what I'm talking about.
So that is the arena?
That is the arena.
Not the GICC?
Oh, you're talking about the convention center. So I'm talking about the arena, not GICC.
Okay, so the 4 million is the arena?
Yes.
Okay.
Yes.
And the GICC, is there a loss?
Convention center had a net loss of 4.4 million. So both of them are very similar.
So 8 million?
Between those two, yes.
So that's about 5 community centers. Could you recommend that maybe we do a operational evaluation on just those 2?
So you all can do that. So I have government say, okay, we know the value of having an operational assessment done, but instead of doing a government-wide assessment, we're going to focus on certain departments. And so you can do that. You can say, we're just going to do one on GICC, arena, or finance, HR. You can break it down like that and get different quotes for that.
So one last question. Hypothetically, if we didn't have those other revenue funds to pay into the arena and GIC losses, what does municipalities do that own those?
It's a good question. So sometimes they will sell them to third parties if they no longer can cover those costs, don't have other funds with the resources, the available funds and revenues to continue to subsidize those costs. So sometimes they look to sell them to third parties, or just bring about, like Councilman Corn said, let's bring in some additional for the arena. Bring in some different sporting events. Bring in an indoor track, a hydraulic track, so you can start having indoor track meets at the arena, like at Birmingham Complex. So I'm being a little biased here because my daughters run track, but yeah, looking at different sporting events that you can bring to the arena that would generate more revenues. And so just kind of thinking outside the box on how you can start bringing in more revenues to those operations. But again, that's something that you have to consider. If the general fund and other funds are kind of providing a lot of transfers to those two entities, you got to make sure you're protecting that flow of revenues coming from those other funds. And so you may be hesitant to want to roll back millage rates because we got to keep covering these costs in the future.
Can tourist product development funds cover that? Does some cities use those funds to cover?
Well, right now, you do have hotel, motel tax revenues and car rental tax revenues that are being, and this is
I
applicable.
meant specifically DMO.
Oh, DMO. You have to go back to the resolutions and things of that nature to see if some of that could go towards that. And so some of it could go to the convention center.
Okay.
But you just got to make sure that you're in compliance with that.
Thank you.
All right, any additional questions? Hearing none, thank you, sir.
Thank
Appreciate
you
it.
all.
It's my understanding the second item has been removed from the agenda, so
That's correct.
we will see everybody at 7:30.
I'll take care. Thanks.
Thank you.
Thank you. Thank you so much.